Okay, welcome to the second panel of the conference, Crisis of Capital, Crisis of Theory. Thank you very much for everyone who's for attending, and of course, thank you very much to our guest speakers. So we have, who wants to go first? Okay, we have Leo Panitch, who is a distinguished research professor at our faculty here at Political Science, York University. His interests are in comparative political economy, state theory. His current work is on finance production in American Empire. He's also co-registered at the Socialist Register. And we also, next we have David McNally, who's also a distinguished faculty member here at York and in political science. And he's interested in global social justice movements, radical political economy, and he's got a book coming out next month called Global Slums. Slump, sorry? Slump. Global slump, sorry. Okay, so and as chair of this session, I'm supposed to massage their egos a little bit. So I just also wanted to mention that so they have a long list of work, et cetera. But what I wanted to mention is that they're also very involved in the community. So they're not armchair socialists. So they're involved in the Greater Toronto Workers' Assembly and the G20, subsequent legal battles, and so on and so forth. So so having declared my respect, I will also be a fascist in terms of time. So I'm going to limit it to 30 minutes each so that we have ample time for discussion, because I'm sure it'll be as stimulating or even more stimulating than this morning. Okay, thank you. Take it away.
Thank you very much, Sean. And I want to thank all of the graduate students and undergraduates who are involved in organizing this. And it's a tremendous turnout, so it's obviously a great success. Crises are, of course, classically defined as turning points. This is almost a banality now. And it's pretty clear that this crisis is not turning out to be a turning point in terms of the reversal of the fortunes of the left, which have suffered so badly in recent decades. One of the reasons it's not turning out to be a turning point, I think a small reason, not the main one by any means, has to do with the crisis of theory, including the crisis of Marxist theory. So it's very much to be hoped that this crisis will at least be a turning point in the sense of coming up with a better theory of crisis. And we'll have to see whether that's the case, and I think that's what is motivating this conference. Let's start with Marx, although we don't have to start there. But let's start with Marx. Exactly 150 years before the current crisis began in August 2007, the Ohio Life Insurance Company in New York triggered what was then the greatest financial crisis. It quickly spread to Europe and around the world, and Marx got very excited and enthusiastic about it. Saw it as the first world economic crisis, touching every region in the world. He felt he had predicted that the next crisis would come. He had predicted that in 1850 in New York, that it would start in New York. And as it moved to Europe, he and Engels started exchanging letters about how much they expected that this would lead to a new revolutionary upsurge. As Engels wrote to Marx, and Marx didn't disagree, we thought 1848 was our movement, but this was our moment, was our time, but now the moment has come, and it's really our moment, and it's a matter of life and death. Marx said he would increase the scope of his study of the Grundrisse to take account of this first world economic crisis, and began to do so while the crisis was unfolding, and he expected that it would soon lead to a major industrial crisis and the undermining, as he put it, of British supremacy. Well, it didn't turn out that way. By the middle of 1858, recovery was well underway, and Marx began to spend his time in the Grundrisse notebooks trying to figure out what had happened. Why were his expectations not fulfilled? And the answer he came up with, and you can find it in the Grundrisse, is that a lot of capital was devalued, but also that a lot of exports went to the colonies. And in that sense, this picked up and revived demand. But as he put it in the Grundrisse, this would return capital and was already returning capital to dynamic growth. That dynamic growth would load up further contradictions by virtue of the accumulation process, and crisis would be renewed at some unspecified time at a higher level, at a higher stage. Theories of crisis became very common, very prevalent, by no means only amongst Marxists, but especially amongst Marxists, once the first Great Depression of 1873 set in. Engels in 1884, just after Marx died, indeed, in relation to that, spoke of the collapse of the capitalist mode of production before our eyes. Generally, the Marxist theories of crisis focused on contradictions associated with the constant drive to accumulation. And this was the appeal of the Marxist FROP, falling rate of profit. That it was presumably explaining the process of overaccumulation. Of course, this is rooted, as Jonathan is right to point out, in Marx's labor theory of value. It's rooted in it in the sense that as more and more fixed capital, dead labor, if you want to use that term, although if we take what Kaminel said this morning about the generality of socially necessary labor time, that is really very, very general. The theory is simply that as you get more and more technology, fixed capital, et cetera, displacing living labor, and since on this theory, the surplus is derived only from living labor, then in terms of variable capital and fixed capital, you automatically have a falling rate of profit. Now, apart from the question of whether it's true that only living labor adds value, which I doubt, whether it's true to think, or useful, I don't know true, but whether it's useful to think in the way, in terms of capital not adding to productivity, when you have capital embodies so much dead labor, you don't have to think of it that way. Is there not capital productivity as well as labor productivity? But even if you think that way, Marx's notion of the FROP was not terribly useful because he immediately introduced the counter-tendencies. And the counter-tendencies are all the things that make capitalism dynamic. They are new technology. They are state intervention. They are innovations in finance. All those counter-tendencies are the things that, apart from counteracting the falling rate of profit, are the things that make capitalism such a dynamic, competitive system. After 1896, interestingly, people, including Marxists, got very uninterested in FROP. Insofar as there was a theory of crisis, and there was, it got mixed up with the theory of imperialism, and that was more rooted in explanations around underconsumption than overaccumulation. Whatever the varieties you want to look at, whether it's Hilferding or Luxemburg, et cetera, they were in some sense combining the centralization and concentration of capital, producing very high productivity and dynamics of accumulation by these increasingly concentrated, as Hilferding called them, finance capital corporations, and an assumption that the proletariat in the advanced capitalist countries where this was taking place would be immiserated, would stay immiserated, and would not be able to consume all that this concentrated capital was producing. As a result, and they had a very reductionist view of the state and of power, as people do who don't accept the Marxist value theory at all. They had a very reductionist view of the state. These big capitals would get their states to occupy more and more of the world, and would engage inevitably in wars with one another, and this was the theory of inter-imperial rivalry. And that was the way in which crisis theory got twisted. When the Great Depression happened, and to some extent just before it, because some Marxists were predicting it, you then got, and it's remained to this day, a switch back to overaccumulation theories, which Marxist theory, I think, remains plagued with today. With expectations from the 30s on, and repeated, although in different ways, from the Monthly Review School by the early 50s to Brenner by the early 90s, although different explanations of what's causing overaccumulation, the notion that we've been in a permanent overaccumulation crisis for the Monthly Review School since the 30s. Only it's been kept going by wars and waste and bubbles. And for Brenner since the 70s. It's been kept going by bubbles in particular. Now, I think many of the problems that we have with Marxist crisis theory, have always had with them, remain. And we need to start overcoming their limitations. To some extent, I think the problem lies in asking the wrong question. The question that is posed is, what is the cause of crises? But most interruptions in capital accumulation, if that's what you take to be a definition of the crisis, get dealt with rather quickly, either through self-correction, through the devaluation of capital, or through some forms of state intervention. The interesting question to ask, actually, is why some interruptions in capital accumulation last such a long time. That's the interesting question. And once you ask that, you really can say there have only been really 3 such crises in capitalism's modern history, if we start counting capitalism as we should properly as a world system to the late 19th century. And that is that first Great Depression of 1873 to 96, the Great Depression of the 1930s, the crisis of the 70s, and perhaps we're in the 4th. In saying that, I think we need to recognize, and I think this is very Marxist, that capital constantly confronts a series of barriers as it attempts to engage in dynamic accumulation. And as it tries to overcome these barriers, they throw up a multitude of possibilities for different kinds of crises. And those crises can be triggered by one cause at one moment, by another cause at another moment, or by some combination of them at a third moment. I think in saying this also, we need to recognize that capitalism, as historically, should not be understood simply as a series of crises. And certainly, capitalism as a dynamic system of production its dynamism should not be understood only in terms of it being driven by crises. The concentration and centralization of capital had begun before 1873, and it continued long after 1896. In fact, it really only took off. Fordism began long before 1930, as Brenner showed in criticizing the regulation theorists, right? And continued right through it and went on like after. Financialization, in the sense that we understand it today, not as finance capital, properly begins by the nurturing of financial capital back to health in the 1940s, 50s, and 60s, long before it explodes as the discipliner and regulator of capitalism after the 1970s crisis, as a way of resolving the 1970s crisis. So we don't want to understand capitalism's dynamism as simply being produced by crises themselves, which I think is a mistake that people make. There are, I think, 3, and I must say I'm laying out here work that is common to Sam Gindin and myself, and it owes as much or more to Sam than to myself. He couldn't be here today. There are 3 theoretical requisites of an adequate theory of crisis. And obviously, and here I'm a positivist as much as anybody, we need to begin with certain facts about the relative and historical and comparative sense, state of wages, prices, rates of profit, etc. And I don't need to go looking for underlying values beneath those in order to be able to try to use those facts. Although one doesn't want to be, as too many positivists are, Mr. Gradgrind in hard times, in which all that matters is facts, and all we know are facts in that empiricist sense. But we need to begin, obviously, by looking at what's happening in terms of trends around profit rates, etc. But we need to do that in a way that locates these facts in given class and state conjunctures. the configurations of class relations and of state relations and state forms in given historical conjunctures. So if we were to do this and take 1873 to 96, at a moment at which you could still say capitalism was more competitive than it later became. It never became uncompetitive, but it wasn't as competitive amongst these organizational giants that Jonathan's work is so useful in terms of us having look at as capitalist bureaucratic organizations, but not driven by the same things, not motivated, at least in their own minds, by the same things as state bureaucratic organizations. And if we look at 1873 to 96, we can see that that form of competition put in the context of whatever triggered the crisis, did produce a devaluation in prices. Prices were not sticky as they became in the 1930s crisis. At a time when labor was more mobile than capital, when there was this massive flow of labor from Europe to North America and to South America for that matter, and even to parts of Africa, right? When labor was more mobile than capital, when it was the safety valve for the reserve army of labor in Europe, right? This gave labor a certain strength, even though it wasn't highly organized by any means. It was just beginning to organize in industrial terms, insofar as prices were falling, especially in North America, where you could go get a piece of land very cheaply. In the 1873 to 96 crisis that opened up all kinds of space. It didn't produce a profit squeeze in the sense of the 1970s profit squeeze, but it did mean that state capacities got developed in that period. Bismarck's welfare state, the development of the first civil service, the first meritocratic civil service reforms in the United States in the 1980s. One could point to others, which were important in terms of building the infrastructure, both social and capital infrastructure, that was important to getting out of the crisis by the 1890s. In the case of the 1930s, Eichengreen is absolutely right in his Golden Fetters, a very important book to read by a bourgeois economic historian, is absolutely right to say that that crisis, although it was triggered by the stock market crash, which was itself triggered by the Americans trying to help out the British after they went back onto the gold standard in terms of keeping down interest rates for a period. That crisis was certainly triggered by how hard it was to return to the kind of discipline on state austerity that the gold standard had required from 1850 till the First World War, mainly because of the democratic victories that workers had won through organization, through winning the right to vote, etc. It simply became harder for states to automatically impose austerity, given the costs that would be imposed on them when they did so, and the British discovered that very quickly with the miners' strike, right, and the general strike of 1926, by labor's victory in 1929, etc. The fact that you couldn't do that was you couldn't get the gold standard back on track after 1926. What was it turned the trigger, the 1929 stock market crash, which again began in New York, very interestingly, what turned that trigger into the Great Depression, as each state then responded to the crisis by interrupting capitalist globalization. Not through war initially, but interrupting it through trade wars, the highest import duties the United States ever introduced in its history, a general duty of 50% in 1930, and that was replicated in states around the world. Capitalist globalization got interrupted. That was an enormous shot at the bow of capital accumulation. Now, in that period, again, you need to look at the class and state configurations. The fact that immigration had been cut off to North America in the mid-1920s had something to do with the safety valve that had been there for the reserve army of labor in Europe in the 1920s, no longer being there. It's one of the reasons for the rise of European fascism. But ironically, it's also one of the reasons for the rise of the new wave of American trade unionism under the CIO, in that constant flow of labor into the United States which had constantly undermined unionization efforts, was removed. And that became a basis upon which, even under conditions of higher unemployment than in the 20s, that the CIO was able to form, et cetera. And of course, we would have to build into this, as a result, this type of state capacities that were developed in relation to that class configuration. You could do a similar thing with, I've got about 10 minutes, right? Yeah. A similar thing with the crisis of the 70s. And here, you know, since time is short, I'll just try to do this quickly. You can see that there's also a certain logic here. The resolution of the crisis of 1873 to 96 is one of the causes of the way in which the structural crisis of the 30s works itself out. That is, the concentration and centralization of capital. Right? The seeds of trade unionism that were set in that period, right, are the factors that have the crisis of the 30s take the form it does. Prices are now sticky. There isn't price competition in the Great Depression, right? And unionization emerges even in the middle of it, with effects on the New Deal state or on welfare states through the Second World War, elsewhere, et cetera. Similarly, in terms of the crisis of the 1970s, the resolution of that crisis, above all in terms of full employment commitments, the development of welfare state commitments, et cetera, is, in my view, as against Brenner, one of the factors that allows the reserve army of labor not even to be operative in the 1960s, at a time when full employment finally is achieved after the war. And it means that workers are indeed, especially state workers, but also private sector workers, very bolshy, very militant about making wage demands and about telling their managers to fuck off when they're told to work higher, because they know they can go down the street and get another job. This has an effect on profits, especially in light of increased competition between Germany, Japan, the United States in terms of recovery after the war, and it produces a profit squeeze, no question. Right? Brenner's right about that, although I think he's wrong to say that the working class doesn't factor in as a cause here. Whether they were chasing inflation or causing inflation isn't important in that sense. In some places, and it probably varied from month to month, some places they were causing it, and some places they were chasing it. So you can see that each successive crisis is to some extent a explanation of the nature of the next structural crisis. I think it's important to say in this respect that a decline in profits does not necessarily lead immediately to a decline in investment. That too is contingent. And that's the second requisite of a decent theory of crisis. That is, that we need to understand the outcomes of crises are highly contingent. And what initially the response to the profit decline in the mid-1960s was in fact increased investment on the part of these massive corporations that Jonathan so rightly centers in his analysis. There was an attempt to introduce new technology in order to increase productivity, in order to cope with higher labor costs. It didn't work. It's not that productivity went down, but that it didn't go up nearly enough to compensate for that increased investment by the early 1970s. And that had to do both with the militancy and power of workers on the shop floor, but it also had to do with them not yet having the organizational capacity to take advantage of the computerization of production. And those two things only came together once the working class was defeated, as it was around the world by the early 1980s, under the discipline of a globalized finance, which industrial capital as well as labor was quite prepared to take the lead in terms of solving the problem of inflation, which all of them were finding problematic. Industry in the 1970s was no longer able to go to the bank and get loans by virtue of the bank feeling that their loans are going to be devalued by high inflation. And workers increasingly by the 1970s were finding their trade union militancy extremely counterproductive in terms of not being able to keep up to the rate of inflation no matter how high their wage demands were. And it was in that context that financial capital, which had already been burgeoning long before the crisis of the 70s, was able to impose discipline via the state, and that too needs to be explained and mediated. We need to understand how the Federal Reserve developed the capacities to do that through the course of the 1970s. It tried to do it in 1970 by doing what Volcker did in 1980, by raising interest rates. That immediately caused a crisis in the commercial paper market. It looked like banks were going to go under, and they pulled back. Volcker didn't do that in 1980. And they had learned things in the intervening 10 years about what types of supports need to be given to banks in order to get them through this crisis. So all those types of explanations that involve class configurations and an understanding of structures of the state and their development need to be factored into any explanation that simply relies on whatever triggered the crisis or on rates of profit. But those are not unimportant. They're relevant, they're important, but they're not the be-all and end-all. In the current crisis, just very quickly, we can also see that the way in which that crisis was resolved proves to be crucial in both the triggering and the evolution of the current crisis. The growing role and power of finance, both in terms that Jonathan's work explicates quite well, and in, I think, broader terms, is very important to understand the development of the types of derivatives that were capable of being the basis for workers having demand for subprime mortgages. You know, we usually want to explain what happened in this crisis simply in terms of deregulation. So it's all a matter of why were the banks or the shysters who were selling subprime mortgages allowed to sell this stuff? But why was there such a demand for this stuff? There was such a demand for this stuff because as workers' wages were constrained through the course of the resolution of the previous crisis, they increasingly depended on credit to sustain their standard of living. And for the most part, they sustained their standard of living. Partly that had to do, of course, with cheap imports from the global south, allowing them to reproduce themselves through Walmart rather than through more expensive working class consumption that previously existed. But they very greatly sustained themselves by being integrated to a very dynamic financial capital. Not at all finance capital in the sense that Hilferding meant it. On the contrary, there wasn't this fusion of finance and industry. Even where it had come together in the 20th century, in Sweden or in Germany, it was being torn apart. Deutsche Bank no longer wanted that type of relationship with the industries it had sat on the boards of and controlled for much of the century. It now wanted to be an American-style investment bank, and it became one. And do you know who owns most of the mortgages in the black residential areas of Cleveland? Deutsche Bank. So that's one element in what causes the crisis. Working class demand for subprime mortgages because this is their only asset. The only working class asset in a society like the United States is the houses they own. It's the only thing they're going to pass on to their children. And they wanted to get into the game. They were encouraged to get into the game by left Democrats, by trade unionists, by black political leaders, by black preachers, back from the 1970s, when the possibility of transforming US cities through building massive public housing, which would have been the next stage of the Great Society program, was cut off by the fiscal crisis and inflation crisis of the 70s. What did left Democrats turn to? They turned to the Community Investment Act, which required banks to lend money in their area to poor black businesses, poor black people who were going to open businesses or buy homes. That was the root of the subprime mortgage crisis, although it got, of course, much bigger when Bush let every shyster into the business in order to convince people to get into the game. So that's the root of the current crisis. It wasn't a crisis that begins with a profit squeeze. It was not a profit crisis. Profits increased from 2004 to 2007 by over 4%. Capital investment increased from 2004 to 2007. This wasn't a crisis that was rooted in that type of calculation. It was triggered by a crisis in finance. It had the effect it did because housing is such an important element in mass consumption in a society like the United States. Not only in terms of what it does to accumulation when developers aren't building houses in any region of the United States, but also in terms of what it means in terms of white goods, refrigerators, stoves, etc., furniture, etc., right? So it has an effect on consumption. On top of that, as soon as speculators inevitably shifted out of trying to find a higher rate than they could get from treasury bills in what they thought were gilt-edged mortgages, were no longer getting it there, they tried to get it in commodities, in resource commodities. So the price of oil had shot up, right? Well, American auto companies had been engaging in competition with their Japanese counterparts by building larger and larger SUVs and being successful at it. Well, as soon as the price of oil, petrol shot up during the course of this crisis, this was a ready-made problem for the auto industry, which was just waiting to happen insofar as working class consumption wasn't there any longer to sustain those type of gasoline prices. I'm done. The crisis not only spreads to industry very quickly, but because of the importance of the United States as consumer of first and last resort around the world, right? It spreads quickly around the world, and nobody can delink from it easily. Which brings us back to the working class, and what is the point of this theory of crisis? And here I think what was said this morning is very relevant. What Marx was trying to explain when he was getting at exploitation and productive and unproductive labor was why this matters in terms of the possibility of what he thought was the most powerful subordinate class in human history. The possibility that that subordinate class, which was creating from 1848 on, but especially from the late 19th century on, its own permanent institutions, the first subordinate class in history to do so, right? To be able to take advantage of crises to change the world, to get us out of this capitalist dynamic. So we have to bring the working class back in. And in that sense, I think we need to see that for however structurally weak, and this crisis is built on the structural weakness of working classes, that there has been a vast increase in the proletariat globally as part of this highly successful period of capital accumulation between the crisis of the 70s and the crisis we're now in. This enormous growth of the global proletariat. And we see in the context of this crisis, like in the 30s in the United States, the increased militancy of Chinese labor. But contingency is everything. What matters now is whether Chinese labor is going to organize on the basis of becoming individualized consumers, which is how the American working class organized, right? Or whether it's going to organize, and this isn't just a matter of voluntarism, it has to do with conditions, or whether it's going to organize in order to secure the collective social needs of the Chinese masses. And who knows the answer to that? It certainly speaks to what is necessary for the American proletariat if it's going to get out of its situation, which is to finally move away from the trade unionism of individual consumerism to a trade unionism of a proper class for itself politics. Thank you.
Thank you, Leo. And like Leo, I want to thank the organizers of this conference, particularly the graduate students who put so much time and energy into making it possible. I think, or I hope at least, that one of the things we're endeavoring to achieve is to bring together a series of perspectives, traditions, approaches within critical heterodox political economy into what should be and ought to be a fruitful dialogue and debate. And what I'm going to do is, because I know there's enormous interest, the first session this morning indicated that, in theoretical frameworks, I'm going to offer a few preliminaries on that, but I'm really going to turn to what my paper title suggests, which is to say some of the transformations in capital that require certain kinds of transformations or developments in theory. So let me just start with a few preliminaries. My approach to Marx's writings is not that they ought to be treated as a dogma. They are a guide to action, because fundamentally, Marx's critique of political economy is about world transformation. However, whereas Marx says in the famous Thesis 11, the philosophers have only interpreted the world, the point is to change it, and changing it was his life's work, note the word only in the first part of the proposition. It's not that we shouldn't interpret the world, analyze, theorize, and so on. It's that it ought not be an end in itself. And it's in that spirit that I approach Marx's work. Having said that, let me then offer you a few theoretical and methodological preliminaries. And the problem here always, and this is something that Hegel states famously in his preface to the Phenomenology of Spirit, is that prefaces, theoretical, methodological preliminaries are inherently a problem. They're inherently a problem because you're trying to tell people what, in fact, the analysis itself has to show. You're summarizing something in advance. Put differently, in the dialectical tradition with which I identify myself, the proof is the pudding, not the recipe. Nevertheless, I don't have time to offer you either a volume 1 of Capital or a Phenomenology of Spirit, so I'm going to have to offer you instead a few quick preliminaries which inform the kind of analysis that I do. First, method pertains to the object of investigation. This is a crucial dialectical protocol. There is no such thing as universal, timeless method that is first developed and then foisted upon phenomena. Serious dialectical critical theory begins with the object under investigation, probes it in such a way that it discovers what modes of analysis and investigation fit the object under investigation. Anything else is dogmatism. As a result, I believe that the term dialectics of the concrete is the correct sort of summary of the kind of procedure that Marx was engaged in. And anything else, again, to use Hegel's term, is monochromatic formalism, the foisting of a pre-established set of assumptions onto phenomena. Secondly, Marx does not start in his critique of political economy with postulates, premises, and propositions. He starts with a form of life. He starts with what he believes to be the germinal form of life in capitalist society, the commodity form. And he believes that there is something that needs to be explained. The commodity form is not self-evident. We cannot take it for granted. It is not natural. It is a unique social historical product. And it needs to be understood as a unique form of life which structures human activities in absolutely unprecedented sorts of ways. As a result, his theory begins with an attempt to understand the commodity form as a form of life, and it moves from there to the value form. And I want to emphasize that fact because Marx's critique of political economy does not begin with something called the labor theory of value. His account of labor in capitalist society follows from his attempt to probe this commodity form, this unique form in which social economic activity happens, and he develops this as what he calls the value form. Third, the value form is a real abstraction. And I want to just spend a moment on this point, because Marx is actually making the claim that the diverse needs and the multiple concrete human life activities which are happening around us all the time are being subsumed by an abstracting force. That is to say, these diverse needs, these concrete, unique life activities, have to be subsumed under a single totalizing metric. Otherwise, there is no market economy. There is no market regulation. of economic life, unless all these diverse needs and concrete life activities can be reduced to a single standard of evaluation. This is what value form analysis is about. And Marx's claim is that this abstracting process, which is the other side of human alienation in a capitalist society, by the way, actually happens to us. Our activities become interchangeable parts of a total social process. Our needs get equated. It's the mania of the utilitarian metric in that regard. Quality becomes quantity. And this is what it means for value to be a real abstraction. Fourth, for Marx, as for, I think, all adherents to the dialectical tradition, things, as Bertel Ohlmann reminds us in the early chapters of his book Alienation, things are relations and processes. Very difficult for the empiricist mindset to grasp this, but Marx comes back to this over and over again, and as Ullmann tells us, there is no theoretical concept Marx uses more in his writings than relation. This is the term he uses over and over and over. We think we're dealing with things. In fact, we're dealing with relations among people and things. Fifth, the concrete phenomenal forms of capital's movement undergo regular transformation. Capital is not a fixed thing. I'm going to come back and talk about this a little bit further in a moment. But because capital undergoes constant transformation, its empirical, phenomenal forms change all the time with the system. And so, just because Marx or certain Marxists referred us to certain phenomenal forms that dominated during their time, does not mean these are written in stone. Not a hell of a lot stands or falls with propositions about specific finite forms. And I'm going to talk about one very significant transformation in this regard in a moment. And then sixth and lastly, in terms of these preliminaries, the issue therefore is not empiricism, which I think no longer stands by way of any kind of serious social or philosophical theory, but the capacity of theory to comprehend, explicate, illuminate real phenomenal forms of life and real social processes. So those are the preliminaries because given the debate this morning, I felt it was going to be important to position myself, even though, as I say, the proof is ultimately in the pudding and very little in the recipe I just laid out. So let me now turn to the problem I want to spend most of the rest of my time on. And this is what I consider to be really monumental transformations in the forms of money that dominate the capitalist economy today, and do so in ways that Marx did not anticipate, in ways he did not foresee. Nevertheless, I think that Marx's critique of political economy retains enormous explanatory power in the face of these transformations. And so I'll just highlight for you what I'm trying to get at. Recall that Marx tells us that capital must move through the money form. Capital must become money. But it is not money. It is not any one of its forms. Here, and this is why Marx uses the term metamorphosis all the time when he comes to the problem of the circuit of capital. Capital undergoes constant changes in its forms. It moves from money, commodities, means of production, stocks of labor power in motion, and so on, back into stocks of commodities, stocks of money, and so on, in a constant circular flow, in a constant movement, which is repeated and expansive. And so capital is not any one of its moments, to use that beautiful dialectical term. It is all of these at the same time, which means it is not any one of them at any time. But the transformation through the money form is absolutely crucial. It is absolutely fundamental. And this is the sense in which I believe Marx does not subscribe to the notion, which I still find Marxists repeating, that there is something called the real economy and there is something called the monetary economy. For Marx, capitalism is a monetary economy, which is very clear from the outset as far as I'm concerned. Capital must move through the money form. There is no capital without the money form. but it's not identical with the money form. Moreover, the money form has inherent contradictions built into it. And the contradiction I want to spend a little bit of time on is that between money as a means of circulation, a way of simply making goods circulate, goods flow. After all, this is the society in which, without entering into the cash nexus, you are fundamentally and effectively deprived of the goods of life. You've got to be able to deliver cash, money, in some form or other, to access the goods of life. And so money is a means of circulation. But Marx tells us it's also a measure of value. And Marx's theory of the measure of value is, I believe, really still under-theorized in all kinds of important ways, including within most Marxian economics. And Marx believes there's an inherent tension here. Why? Because, in principle, capitalists want the widest possible, most expansive, most extensive, most accelerating circulation of goods. Therefore, proliferate money forms as much as possible. Problem: capital also seeks, as stable as possible, a measure of value. This is a constant problem for capital. How do you measure value? How do you, in a world of uncertainty, base investment decisions on some sort of reasonable expectation of a positive return? It's a constant problem for capital. How do capitalists know the value of the products that they will be bringing to market? It's a very serious issue for them. As a result, some reasonable stability in the measure of value is built into this problem, this dilemma. Now, Marx assumed that, based on his living experience, that when the crunch came, capitalism would regularly choose the stability of the measure of value, that would be its ultimate priority. And therefore, he thought some kind of metallic monetary standard, a gold standard, was going to be essential to the system. Very reasonable proposition in his time, very reasonable proposition in his time, but untrue today. The world has changed in all kinds of interesting, complex, and bedeviling ways. But Marx thought it for reasonable reasons. I want to explore that a little bit. One of the reasons he thought it, by the way, was not because he was a metalist. Marx was very aware of the proliferation of paper forms of money, fiat money, credit monies, and so on. They're really fascinating chapters, all of them unfinished, just draft notes, really, in what makes up the so-called third volume of Capital, which we need to remind ourselves, volume 3 of Capital is a series of draft notes that Engels then tried to give some coherence to later. But that's what it is. It's a set of notebooks. But nevertheless, the discussions of credit money and so on are quite interesting. Marx was well aware of them. But Marx tells us there, and in the first volume of Capital, that at the world level, gold or some other commodity will have to reign supreme. Why? Because states are national. Never occurred to Marx that a national currency, a currency issued by a nation state, could function as world money. Well, guess what? It does. It has, since at least 1971, when we get the full decommodification as opposed to the partial decommodification of world money, which existed under the Bretton Woods system. So something new and unprecedented, not anticipated in Marx's theory, entered the world. And it seems to me that this is really crucial for understanding all of the phenomena of contemporary capitalism that tend to get lumped under the not very helpful rubric of financialization. I'm not a big fan of the term. I'll use it because it becomes a common place, and I think there are ways of using it perhaps fruitfully. But fundamentally, what I want to suggest is that many of the phenomena that people try to understand under this rubric have to do with this mutation in the form of world money. The total breaking of a relationship between world money and any commodity, which is, as I say, a novel and unprecedented phenomenon in the history of capitalism as a world system. We move into a world of officially fully decommodified money. And one of the things which happens predictably is enormous new volatility in money markets. Currencies start to float is a term that they like to use to describe it, but floating looked a lot more like gyrating as you watch the 1970s. Nobody was any longer certain what the dollar meant as a measure of value for the world market, for the world economy. So there was massive speculation against it, into other currencies, back into the dollar when certain moves get made by central banks, and so on. We moved into a world of enormous exchange rate volatility and a huge explosion in foreign exchange trading, in currency trading. And one of my key claims here is that it is this de-anchoring of world money from any commodity form that leads to an explosion in currency trading, which is itself tied to the proliferation and explosion of new financial instruments that we now call financial derivatives. That there's a clear set of interconnections here because in a world of enormous monetary instability, put simply, if you're a German multinational corporation operating in the US and you have a 10% rate of return for the year on your US operations, all of this is being booked in dollars in your US market operations. And the dollar falls 10% relative to what was then the German mark. You got no profit, folks. This is a huge issue. It's a huge problem. Monetary instability, the floating of currencies now becomes a threat to any kind of stable profit-generating activities by firms operating globally. And so they enter into a whole series of moves designed to hedge the risk of profits being wiped out. And I won't bore you with the details of futures and options and so on, swaps, except to say that there is a proliferation of increasingly exotic financial instruments, which we call derivatives. One of the earlier Marxist commentators to begin to see the significance of this was Dick Bryan, and while I don't agree with Dick on some points, his book Capitalism with Derivatives is one attempt to really begin to explore some of what's going on here. As a result, it's too trivial and impressionistic when commentators come along and say, for some unexplained reasons, maybe a neoliberal zeitgeist or something like that, speculation went crazy. The speculative argument is just too simple. There is a structural transformation which actually makes risk with respect to the money form objectively, powerfully greater and more problematic for capital. And as a result, there's a proliferation of instruments designed to overcome this risk. I won't take you through, how am I doing for time, by the way? 10 minutes. Okay, yeah, so I'm not going to give you some of the empirical stuff on the explosion of currency markets, the size of derivative markets, and so on, except maybe just to quickly tell you that derivative markets today massively eclipse global stock and bond markets. Like massively, 10 times greater, that sort of range. I mean, this is a huge transformation in terms of how the system is working. Not that derivatives were new, futures, contracts, and so on, go way back to agricultural markets and so on. But these forms of financial derivatives and whole markets devoted to them is something powerfully new. One of the key issues and one of the really interesting problems about derivatives, and I won't have any time to develop this here, but I'll just note it for you, is that derivatives are allegedly based, their prices are ostensibly based on the underlying value of something. That's pretty shaky. In reality, their prices are predictions as to the future value of something. That is to say, the way that's been talked about in some of the more interesting Marxist literature, there's actually an attempt to monetize temporal shifts. And by the way, this is one of those places where I think the work that Jonathan and others have done has some interesting points of convergence. I think that the theory of differential accumulation has some interesting points of convergence with some of the more interesting and creative work being done by some Marxists in these areas. Now, I want to from here come and talk a little bit about how all this plays out in terms of the most recent crisis that we've been looking at, and why I think that a value abstraction-based theory has something to offer. You see, a lot of the commentary on the banking crisis that breaks in 2008 really has its origins about summer of 2007. A lot of the commentary is the crooks, cheats, and swindlers commentary. Far be it from me to deny the existence of crooks, cheats, and swindlers. There are many of them. But there was one commentator, a financial journalist, who quotes one of the financial analysts / speculators who saw the meltdown in the subprime housing market coming. And he makes the claim, he says, there were more morons than crooks. Now, that's interesting. I'm going to push that a little bit further. What he means by that is, if it was all crooks, we have a problem explaining how it is that when the crisis hits, virtually all of the major investment banks in the world are holding billions of dollars of the toxic waste. Tens of billions of dollars of the very toxic waste they were peddling. They were holding on to it. They had lots of it. Some of them, Citibank, actually had a series of arrangements called liquidity puts, which required them to buy back the junk if its prices fell. You had a whole series of mathematical financial economists working for major banks and investment agencies who believed their numbers, who believed the toxic junk they were selling. And there was an underlying theory, and I want to spend a moment on this. Because modern mathematical risk management techniques was essentially deployed based on a concept called value at risk. And value at risk became the measure that was being used by banks to try to assess just what risk was posed by various assets. Okay? Then you price this risk, which means you have to commodify it. You have to attach a price to it. And then essentially you buy financial instruments based on their risk, based on the prices that govern the risk models. I won't bore you with the details of how they did this. Was to read the stuff that the quantitative analysts were believing is quite fascinating. They were bringing together a whole series of efficient market hypotheses with models borrowed from the natural sciences. They then wedded this to basically to bell curves and so on. I won't bore you with the details of all of that, except to say that these people believed, and they deeply believed it. But note the key thing about value at risk. It assumes that there is something that could be described as abstract risk. That one concrete risk in the world economy can be equated with another, and another, and another, and another, and another, ad infinitum. Let me give you some examples. It means that each and every risk from, for example, the effects of climate change on Florida's orange crop, to the risk that the Evo Morales government in Bolivia might nationalize the hydrocarbons industry, to the possibility of a housing crash in the United States. All of these concrete specific risks have to be equated.
And are tradable.
Exactly. They have to be equated. They have to enter into the same metric. They have to come under the same value abstracting form so that they can be priced on the same metric, and as Leo says, can become tradable.
Commodities.
Yeah, we can trade these
We
risks.
call them tradable commodities.
Exactly. But abstract risk is precisely, I'm going to argue, a development of the value abstraction in a particular context in which one form of world money is being supplanted by another. This is an extremely important challenge for all critical and heterodox political economy, including Marxian economics. As I say, I think the concept of abstract risk coming out of Marx is very useful there. One of the things it also requires, by the way, is that you reify time. Time has to become space. Time has to become a quantitative unit, a numeric entry into an equational system. And if I say to you that time is not a quantitative continuum, that time is the qualitative space of human life and historical transformation, I've broken with the models. You can't quantify those things which are inherently qualitatively different to the point that they're not quantifiable. This is a huge problem when this crisis breaks. That is to say, the assumptions of reified time, that tomorrow is effectively the same as today. And by the way, so kooky were some of these models that some of the banks were using that when it came, for example, to what the ratings agency Standard & Poor's was doing with respect to the housing market, they had models for the US housing market that could not accept a negative number. The models couldn't accept it. A negative number, i.e. a decline in housing prices, was not possible and was refused by the model. Okay? And of course, they had something called historical value at risk, which showed, based on 2 years, by the way, which showed that since it hadn't happened for the last 2 years, it couldn't ever happen. That's what you have to do. You have to quantify and then extrapolate based on your quantified time metrics. So I really want to conclude, because I know I'm very, very close to the end, by way of saying that some of you will know that in 2008, when Alan Greenspan appeared before the House Congressional Oversight Committee, he was asked, well, what happened? You were chairman of the Federal Reserve. You oversaw the housing bubble. You oversaw these financialization processes, quote unquote, and so on. What happened? And Greenspan says, I was shocked and so on. Then he says this really interesting thing. He tells us, referring to modern mathematical financial economics and its models, he says the whole intellectual edifice collapsed in the summer of 2008. And it did, by the way. Totally collapsed. But one of the arguments I want to make here is that if we take seriously the value abstraction as the key to understanding the inherent forms of life in a capitalist economy, then the moves towards these insane value at risk formulas have an inherent social logic. But that inherent social logic means that just like the capitalist economy contains explosive contradictions, so did these particular forms of trying to model and manage risk in these financial and derivatives markets. Inherent in that is the reification of time, which I believe is one of the things which Marx is driving at. Moshe Poston's book, Time, Labor, and Social Domination, is still one of the richest explorations of how the value form really requires abstract time. And without abstract time, value forms don't work in terms of actually commodifying, pricing, and so on. In other words, what I'm suggesting is that there are key theoretical moves, I believe, that Marx makes that have interesting points of convergence with the work of Jonathan and others, which remain really fruitful in terms of research programs. Because ultimately, if the point, as I said earlier, is to have a guide to action, to understanding the world in order to change it, then ultimately every critical tradition, every heterodox tradition in political economy has got to be able to generate research programs that actually address changing forms of life. And I've tried to share with you a little bit of where my thinking has gone with respect to some of the unique forms of money that figure in terms of the latest crisis of global capitalism. So thanks very much.
Okay, thank you very much to both of our speakers. So we have about half an hour for questions. I think I'll take 3 at a time. Stefanos, yeah?
Okay. I've got 3 questions for you, Leo, 3 criticisms and 1 question for you, David. It's a lot. I'll try to be very brief. Leo, I think that you did something that the previous speaker refused to acknowledge and refused to confront. Namely, you conducted an empirical analysis without relying on value categories.
Yes.
In a sense,
Why do you assume I would rely on value categories? Can we finally get over this?
I did not. Let me continue.
I don't acknowledge anything.
I did not assume that you would. I just noted the fact that you didn't.
Yeah.
Okay, this is very good. Now, in this connection, my first question to you is this. And actually, this is a credit to a previous speaker. What do you think Marx did wrong in his work in trying to understand class relations in capitalist society and class exploitation by using value categories? How, for him, exploitation, just a moment, you can tell me what he did wrong, but for him, exploitation was not connected to the rate of profit. No, it was connected to the rate of surplus value. That was the rate of exploitation. So what did he do wrong in going this way, in your opinion? Second question is this. How do you understand exploitation? What is wrong with capitalism? Do you have a theory of capitalism or exploitation that informs your empirical work? And if you can spell it out. And the third question is this. You mentioned that this subordinate class in a capitalist society, the industrial, or not industrial, the working class, is the most important class because this is the one that throughout history has the greater capacity to change institutions. Well, it has competition. What about the small independent peasants of classical Athens? That's the third question. Now, in terms of you, David.
Sorry, try to keep the questions short, please.
Well, I'm trying. You know, I am trying. Yeah. I'm trying. All right. Three critical points in the interest of greater fairness and accuracy. All right. Now, I completely agree with the observation that the method pertains to the object, that it has to fit it. But let's give credit where credit is due. It's Aristotle who came up with this idea, Nicomachean in ethics, politics, and metaphysics. Let's give him some credit. The second is that you drew a distinction between forms of life on one hand, with which Marx begins his analysis of capital in the commodity form, and some kind of premises, propositions, or postulates that are an alternative. More of a false dichotomy, David, because everything that you said about Marx's beginning, how he understood the forms of life, was simply another form of premises, propositions, and principles, differently derived, but not qualitatively different. You didn't use anything but propositions, principles, and the like in order to discuss the forms of life. Third critical comment, Allman and the dialectic about there are no things, there are only processes and relations. Well, it's not even Allman, it's Hegel and it's Heraclitus, but that's a minor point. Allman's problem with the dialectic, because you have mentioned him positively many times before, is that it means nothing. For Marx, the dialectic is supposed to describe a movement from the abstract in thought to the concrete in thought. So I have asked Allman, I am asking anyone, according to Allman's understanding, any time that you have an abstract in thought, you have much more than one less abstract in thought. So from which one to which one, why and how? Hegel could do it because he had teleology necessity. How does Allman do it? When he wrote this article in New Left Review, the relation between the jacuzzi and the emperor in Japan, and he used his dialectical method, it's nonsense. You could arrive at the same triviality without dialectics. So there is a problem. The question to you, it was fascinating to hear you use the notion of reification of time. Yes.
I'm sorry, maybe we'll give you a panel tomorrow if you want to.
No, I don't want the panel.
Yeah.
I don't want the panel. No, you got me wrong. The question. You seem to have been able to operationalize value categories in terms of the value form analysis. Actually, you guided us to this fascinating notion of verification of time and abstract trees. And that you answered, in a sense, my question. Is value theory empirically operationalizable? If yes, how? If not, what to make of it? But there is much more to value theory than simply the form. What about the rest of it? How? Okay, and that's a question. What does it mean in terms of its possible empirical operationalization? I'm done. I'm gone.
Okay, thank you. I have Jonathan, but I would just like to get the gentleman in the back who hasn't spoken yet. Yeah.
I actually have a question, and it will be very, very brief.
Thank you.
And it is directed to David. How can we unlock reified time if we limit ourselves to historical analysis from the past to the present? aren't we missing something in the Marxist approach to the historical situation? And I'm alluding to the not yet, for example. Could we elaborate on that, please?
Okay, and Jonathan?
Cannot speak as fast as Stefanos. My question is to Leo. You argue that you offer us a theory of crisis, and I'm not sure.
The mic's not on. Yeah.
You argue that you offer us a theory of crisis, and I'm not sure I understand what this theory is. And I think we have to go. Yes. I think we have to go back to Marx on that. Marx had a structure on which everything else was built, and I think this was a structure that was denominated in values and in surplus value, as I indicated earlier this morning. And this structure enabled him to speak of investment. Investment, for example, was the amalgamation of dead labor, whether you measure it by historical inputs or by replacement cost. So it enabled him to measure technical change, which meant less labor inputs for the same output, or identifying what industries versus finance. Industry produces value, finance does not produce value. Now, you once told me that I shouldn't deal with the labor theory of value because it was too divisive to Marxists. And now you reiterate that actually it's unnecessary for your work, and this in relationship to Stefano's question, you don't use those categories. But then I think you use all of the concepts that Marx derives from labor. You talk about investment, you talk about productivity, you talk about the division between finance and industry as if they were trivial. And to me it seems that you're using really liberal categories, because if you do not use the Marxist categories, how do you know what investment is? In what units do you measure it? In units of utils? Or how do you know what finance is? Because you don't know whether the operation actually generates value or not. Everything is financialized. Every activity in the market is. So how do you decide what value is generated by finance and industry, and how to separate between them? So what I think you end up with is a list of assertions that you accompany by statements such as this is surely the case, or this is undoubtedly the case, but I do not really see a structure to your argument why I should accept your propositions or reject them. I could make the opposite propositions with the same decisive language, and I'm not sure how to distinguish between my conclusions and your conclusions. Thank you.
Okay, so taking however you want.
Okay. Yeah. Let me first make a couple of points in relation to what David said, which I think is very rich and very helpful and carries us forward very usefully. Insofar as financial derivatives measure abstract value, I do think we need to come to terms with the fact, as David said, but I'm not sure everybody heard, and maybe he didn't quite end up by making this point so clear. They are not measuring abstract value in terms of labor time. So there is a search for abstract value, and Marx was right to want to look for one. Does capital, or does capitalism actually develop a means of measuring abstract value in terms of labor time? Well, George would no doubt say very indirectly, but yes. But very, very, very indirectly, it would have to do with socially necessary labor time in the most abstract sense, which is probably immeasurable for, as far as capitalists are concerned in that sense. And I think we have to say that, and we have to need to think about this in terms of the limits of Marxism, and what we need to do is the measure of the foundation for derivatives measure of abstract value has been, and David was getting at this too in terms of the crisis of the US dollar in the 70s, has been the US Treasury bill. Why is that? What do we do in terms of a theory of the state to explain why it is the US Treasury bill that is taken as the foundation of all other calculations of value? Now, and this relates very much to the question of should we think of the economic and political as separate? In what senses should we think of them as separate? The reason that it is such, and I just was writing this up yesterday, so it's very much in my mind, is that the volatility that the markets were speaking of and the development of derivative markets was such through the 1970s and 80s that we didn't get deregulation, we got regulation. The BIS Basel I agreements, first established between London and New York, between the British government and the American government, through their central banks, meeting in Basel, Switzerland, established a zero, which required the G10 central banks to impose upon their banking systems a measure of capital adequacy. And it meant that every large bank within them, and then there was derivative forms for smaller banks, regional banks, community banks, etc., but every large bank within them had to maintain a certain ratio of capital to assets. OECD government securities were given a zero valuation. That included treasury bills, but all OECD government valuations, assets, bonds, right? But the only one of those that was fully tradable around the world, marketable around the world, was in demand around the world, was the US Treasury bill. Now, the reason that mortgages got rated in the loony way that David speaks of relates to the fact that it was assumed by world markets, from the Deutsche Bank to the Landesbank and to the Chinese state, that the American state would stand behind the bonds of Freddie Mac and Freddie Mae, even though they had been partially privatized by Lyndon Johnson during the fiscal crisis and the Vietnam War in 1968-69. So the abstract valuation is based on some calculation of future risk of what the price of US government bonds will be in the future. Any theorization that we're going to get at in terms of what David was speaking to, therefore, needs to build into it a better theory of the state, and why some states are in this position and others aren't. Because sterling, for all of the fact that gold was so important, that I think, as I said in my talk, it was very important, began to play that role as a world currency, after all, from the mid-19th century on. Okay, so that's the first point, and I think we need to deal with that. Secondly, where Marx, I think, is very important, and we need to think about this in terms of labor time, is in this. The logic, if it is reduced living labor that cause crises in Marx's theory, would be that a worker would read this and would say, and it's in the immediate interests of workers in any case, that they would resist the displacement of living labor by dead labor. And of course they often do. They resist the introduction of labor displacing new technology, right? They don't want crises. What did Marx advise them to do? He advised them to secure less labor time, not more labor time. So he was inviting them to induce capitalist crises. And indeed, in the Grundrisse, he makes the point, and it's a very important one, that labor's way forward is not within this framework of the FROP, but is indeed to step beyond their role as the chief actors in production to become the chief actors in society. And the central condition for this is the general reduction of the necessary labor of society to a minimum, which then corresponds to the artistic, scientific, etc. development of the individuals in the time set free and with the means created for all of them. So this very much relates to this question, I think, in terms of Marx's vision of this. He wasn't primarily interested in explaining or preventing capitalist crises. He was interested in transcending capitalist social relations, and that was the core of what he was trying to do in terms of freeing people from wage labor and labor time. Okay, this relates to the questions that Stephanos keeps pushing, which is, why did Marx use value categories, etc. Well, he was using value categories because the classical economists were using value categories, and he was determined to try to come to terms with this stuff. E.P. Thompson once said that he wished that Marx had never spent the decades he did writing Capital. Whether that's good advice or not is another question, but that isn't all that Marx did. even in terms of those value categories, what do I accept? I think it's a very useful conceptual device, and one with real empirical reference, that allows us to understand that a worker exchanges his time to a capitalist for a contract that he will receive a certain amount per hour. In 3 hours, he produces enough for that capitalist, together with the fixed capital the capitalist has provided him, and with other workers, that recompenses the capitalist for what he pays him. But he's contracted to work for 10 hours, or 8 hours, or 6 hours. That is a useful concept in terms of understanding a central element of exploitation. Are all of the dynamics of capitalism, or all of the sources of profit and productivity derived from that? No. Why do we have to assume they are? Is it an important element in profit? Yes, sometimes more, sometimes less, depends on the nature of the industry, et cetera, et cetera. Depends on competitive conditions, depends on the type of technology being used, and the amount of productivity that it produces. So I don't have this enormous problem in terms of assuming that Marx is all about this one explanation of exploitation and everything must derive from it. The point about past and present is crucial. Marxism is a historical materialist theory. It's a historical materialist theory. It is designed, it seems to me, to explain how we got from there to here, how we got from the past to the present. The mistake of Marxists is they think that if they understand that, they can control the future. And they can't. Nor are they necessarily very good at predicting the future. Right? That's not to say that the derivatives markets are necessarily better with their extrapolation of trends, which is what all they do, is extrapolate trends. Okay. I wasn't offering a theory of crisis, Jonathan. I thought I said very clearly I was trying to lay out some requisites for a theory and then give examples of why I think those types of requisites have purchase. So the requisites are that we take facts, and I would take them at the level that capitalism, or at least the Statistics Canada, offers them to us. That is, trends with regard to prices. I'm not a value theorist. I don't have a problem with this. I don't understand. Yes, they are. They're measured in terms of the way capital finds them useful. Exactly. Yeah, you have your answer. And I don't think that differential accumulation is unproblematic in that, or unuseful in that respect. I think it's very useful. But I have no problem in then saying that a narrow examination of that, outside of historical conjunctures, class configurations, state forms, is just that. It's extremely narrow.
Did you want to?
Okay, maybe I'm just going to, there were several questions thrown at me. I'm going to try to be brief so we can get more discussion in. I don't even know if Stefanos is still in the room. Oh, that's some. Oh, you're taking notes for him. Okay, then I'll just say a couple of things really quickly. I will still say that Marx begins phenomenologically, not with premises and propositions. By the way, that's not unique to Marx. Hegel makes the same move in the opening chapters of his Phenomenology of Spirit. He says, I'm going to begin with the taken for granted of everyday experience. In everyday experience, says Hegel, we all think there's a world here. But you know what? That's more problematic than we think. Okay? Similarly, Marx says, in our practical activity, every day we move in and through the market. We live and move through the commodity form. It can't be taken for granted either. That's a phenomenological starting point. He says to us basically, what did you do today? Look at our cups, look at the lunches we had, look at the TTC fares we paid, look at the rent, mortgages, and so on. We have been moving through the commodity form while we slept, while we're awake, and so on. Just like we get up in the morning and we move through a world that we take for granted. Okay? So I still say that his starting point is phenomenological, not premises and propositions. And Stefanos will never forgive me for the fact that I think the opening chapters of Bertel Ollmann's book, Alienation, are very useful introduction to ways of thinking dialectically. I still think that, Stefanos notwithstanding. The other point I'll refer to, and it just links back to one of the points that Leo touched on really quickly, is Mauro's point about reified time. Because I think one of the things which is going on in Marxist political economy, and particularly, and Leo was just beginning to hint at this, in his call for a political economy of the working class, which is what he explicitly thematizes in the struggle over the working day. One of the ways of thinking about that is that Marx is saying, for the working class, its struggle for freedom fundamentally entails the reduction of the amount of time it must devote to linear, homogeneous clock time, working for capital, where all it does is get subjected to this quantifying metric, watching the clock and producing according to the demands of stopwatches, computerized programs, and so on. And it's time away from that. Marx calls the limiting of the working day the first victory for the political economy of the working class. It's the reduction of the time where you're subjected to capitalist reified time. And I think you're right, Mauro, to suggest that inherent in that is the idea of non-linear, non-reified time, as the beautiful little passage in the third volume of Capital, where Marx just in passing refers to free time as the space of human development. Okay? And that's the not yet. Every struggle, every moment that workers win away from capital is a little foretaste of that space of human development, which requires that qualitative leap, the not yet. And Walter Benjamin in particular really picks up on this theme about the break from linear homogeneous time as being inherent in the transformation out of capitalism. So I think what Leo was saying about the political economy of time and workers' time away from wage labor relates directly to that.
Okay, thank you. So speaking of reified time, we're officially out of it, but can I indulge the table to another 5 minutes or something? Or is that okay? For sure. So I had a gentleman in the back that really wanted to ask a question.
Thank you. Leo, admitting that dead labor could be a source of valorization, which I don't have a problem with, is a major breakthrough from the original thesis, because the value in the dead labor is already realized and cannot come back into, and then on the basis of that you have to change variable capital, constant capital, fixed capital. So that's why I say that for today, I mean, for these days, we have to make all this as a basis of research, how changes in theory of value, without doubting the major tenets of it, it has got implications for all of these things. In the same manner for productive or unproductive labor. If we keep on separating these two, now the so-called productive labor is just a minority in almost any country, forget about advanced industrial societies. And for David, you know, I mean, I wish we had time, you know, I have some problem understanding that Marxian economy is about money capital, you know, if I understood correctly. Because money, Marxian economy is mostly for quote-unquote real capital, mostly productive capital. And today's money capital is very different from the time of Marx, because unfortunately it has very little to do with commodity production. You know? And so these are other points that I will not take time.
Sabah, did you have a question?
No.
You pass? Okay. Anyone else, or should I? Oh, sorry, Jung Cho.
I think so. One of the problem in the Marxist political economy is that Marx doesn't start with the discussion of credit money. Actually, I believe that capitalist social relationship based on the creditor and debtor relation. Actually, in England, already in 30th century, labor is already as a commodity. It's bought and sold. widely among people. But what distinguishes between the capitalism and feudalism is that birth of credit money. In late 17th century, goldsmith bankers create a certain scheme in which they create money in the form of credit. By doing that, they offer that certain way of extending money, and then solve the chronic problem of money shortage that has existed from the late Middle Age. So, in the present financial system is actually a breakdown of credit and debtor relationship rather than something other. Also, So, so political economy should focus on how capitalist institutions maintain this risky. Credit debtor relationship is always risky because there is always credit doesn't have a risk of not being paid. So our political economy focus on how capitalist institutions maintain this risky social relation. So I think it's Marxist political economy missed that important point.
Okay, thank you. Would you like to respond? A few minutes?
Well, just to pick up this last point, perhaps Saeed's point. I'm not sure that we ought to be clinging to these concepts. One can use them provided one understands that if you ever understood productive labor just as industrial wage labor, as opposed, as Marx made it very clear, to a piano teacher who is working for a private profit-accumulating firm, you misunderstood what he meant by productive labor from the beginning. That said, there presumably is some worth in the distinction between public employees who are not engaged in the type of organization that is calculating differential accumulation in terms of its reproduction and growth, as the type of organization that is, which is capital. So there's a distinction. Now you still get into all kinds of stuff about whether public employees are indirectly productive. Are the 2,000 staff at the New York Federal Reserve who were playing a role in developing the rules for derivative markets, which were then going to allow abstract value around the world to be measured, are they indirectly productive? Because without all of that happening, we wouldn't have had this tremendous explosion of global capitalism through the 1980s, 90s, et cetera. Because, as you see, it's been industrial firms that have been most concerned about not having over-the-counter derivatives traded, because it allows them to hedge when they make a contract for Chinese labor to deliver something to International Harvester in Chicago. It allows them to hedge both time and space and exchange dimensions with regard to currencies. So this is indirectly productive. I'm not sure we should use the categories, but we have to find something else if we're going to displace them. I think the point on creditor-debtor relations is interesting, but you need to give some social substance to who are creditors and who are debtors. Most merchant bankers, for most of the millennium you're speaking of, lent money to states. That's what they lent most of their money to princes, right? And there are people in this room who would tell you that although you'll find wage labor long before the Italian city-states in the 12th century, in fact, you won't find that it is the predominant relationship in many societies, even European societies until the late 19th century, and for most of the world until the late 20th century. Now, who are the debtors? Insofar as you have a credit card or you take out a mortgage, you're a very different debtor than the Chinese state, than the capital that is being studied in terms of the capital organizations like International Harvester, or for that matter, investment banks, who are on both sides as creditors and debtors. So you need to put some substance into these concepts of creditors and debtors, which is unfortunately what Weber didn't do when he created these different class relations. Yes, there are labor capital ones, but there are creditor-debtor ones. Yes, but who are the creditors and who are the debtors in terms of social relations? And you would need to do that, and I don't think the Brodelian tradition does that very well.
Okay, just a few quick points. Saeed, I'll start off with the issue that you raised, because I'm serious when I say I don't believe that Marx uses the distinction real versus financial. I just don't believe it. I don't see him do it. I see Marxists do it. Ben Fine does it in the latest issue of Historical Materialism. And all kinds of people do this. But if you even think about the movement that's happening in these early chapters of Capital, Marx starts with the commodity. Where does he move next? To money. Why? The circuit. What does he tell us? The general formula for capital. Money, commodity, money. Okay? He's got it before he moves to the purchase and sale of labor power. How is there purchase and sale of labor power without the money form? It's an exchange of money, wages, for labor power, and so on. So I know I agree a lot of Marxists do this. I think they have picked up on a lot of physicalist ideas about what capital is that I don't think are grounded in the moves that Marx is making in his text. And so, well, yeah, I'm sure we probably need hours of discussion on all this. So that's my own view. I think sometimes one of the reasons that people slip into that is because they don't understand Marx's concept of fictitious capital. And they think that Marx means fictitious capital is just like phony, speculative stuff. No, 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 no. It's essential to the credit market. It's essential to the whole structures of credit within capital. All he's drawing attention to is that this is a form of capital which is short-circuiting the process of production, okay, with purely futural expectations, not grounded in the mobilization, direct mobilization of labor power. That, to me, is what he's getting. He actually, he picks up the term from Sismondi. That's where he gets the term fictitious capital. And I think that's been a problem for a way a lot of people understand it. But if we understand value as a phantom objectivity, and the two ideas, okay, that you can't touch, you can't grab value, but it's constantly in motion, it's moving through all these forms, which do have empirical manifestations, then I think it takes on a different light. The final point I'll make is that one of the huge, open, underdeveloped areas of Marxian political economy is Marx's theory of rent. Marx doesn't complete his own theory of rent, but what's fascinating there is he's now moving into an area where he is saying there is a surplus out there not directly derived from labor. It has to do with a monopoly, and I said directly, I don't say it has no relation, not directly. It is because of a monopolizable, scarce natural resource that generates a rent. And then he goes into his theory of absolute and differential ground rent, and so on. And lots of interesting work has been done extending it from ground rent to, for example, dealing with issues like oil. But more recently, people like Tony Smith have developed it, I think, in very, very suggestive, kind of fruitful ways around the idea of technological rents. What about using the patent system for monopolization, okay, of intellectual knowledge? Again, it's something that Jonathan's theory takes up in really suggestive and fruitful ways. I think these are spaces for dialogue and debate in really interesting ways between different traditions in critical and heterodox political economy. So that's just, one of the areas that I'm signaling that all of our work is significantly underdeveloped. And my hope is that that's what we're using a conference like this for, to begin the important dialogue, not of defending pre-established positions, but talking about the research programs that can be generated by actually working with the kinds of theoretical categories that we're debating.
Just one word. Marx fired off a letter to the German Social Democrats, the critique of the Gotha program, when they wrote that labor is the source of all wealth. He immediately fired off a critique of it and said, that's wrong, it's not true, it's labor in nature. And as David just said, what Marx meant by nature was not just some original, pristine nature. It was second nature, the nature as it had already been changed by human labor, and he had every conception, Said, that that changed labor was also productive of wealth. Right? Just as fixed capital doesn't absorb all the added wealth and then not add anything new, so does the way labor is changed continually add new to what is wealth in conjunction with living labor. Marx was not a labor theorist of wealth in the narrow sense that people imagine when that is criticized. Not at all.
Okay, thank you very much for the. Sorry for being over time. We'll break for about 10 minutes, and we'll get into Jonathan Nitson's talk. Thank you.